Good morning, everyone. This is Brad Matheny. Today is Sunday, May 25th. I'm coming to you from let's call it remote location. I'm not in my normal office or location, spending time with the family, but a couple of interesting comments and topics came up, one of which was risk. And now I want to talk about risk and risk exposure. So let's come down here and containment. So understand that risk is a part of trading. Whenever you get into a new trade, risk levels are established. And I'm starting with this blank SPY chart because I want to show you a couple of things so you can be aware of, risk levels and containment systems and how to use them, particularly in Fibonacci use. So where we have risk containment is in the idea that when you get into a trade, you have a certain level of risk initially in the trade. Of course, you don't have any profit right away, you don't have any loss right away, but initially, when you get into a trade, that's what I call the highest probability of failure because at that point, it could go against you right away. And of course, it could do this at any point in time, but it's really you go in full equity, whatever it is, and at that point you're either plus or minus. Now, if you move into the plus side, your risk side kind of diminishes a bit, but it's still there until you pull the profits on the plus side. So something I'm going to try to explain to you is Fibonacci. So let's just take a look at this example here. Okay. We have an example here of a pullback coming down from here to here. Now, I've taught you before, and I continue to highlight the fact that we have this 382 to 618 level. I call it the battle zone level that takes place in price. But we also have this 25% level, which I'll draw it here. And we have this 75% level, which I'll draw it here, which play very important outer target roles. So in outer target levels. So in an example where we move up, reach a peak, we come down here, set this low. So now we're talking from this point forward, hypothetically, back over here, we set a low. We've gotten back above the 75 or the 25% level. What we would be watching for is this type of a pullback. Okay. Because price is always moving into, sorry, wrong one, into an attempt to find higher highs or lower lows. Now, we do not know this is the bottom yet, but we're looking for this kind of a pullback. Okay. And I'll show it to you later up here in this little move too, because it looks like it played out. But ideally, you want to try to find some range that is, outside of a standard deviation channel. So we can just take a look here. There's this outside of a standard deviation channel from here to here, very cleanly outside the standard deviation channel. This is considered a fairly aggressive pullback. That means that you've got the chance of reversion outside of this standard deviation channel. Reversion meaning a move back to the upside or to the middle area. So now when we're looking at this level, spread this out, and we reach this lower level, as soon as we get some solid trending to the upside and get this pullback rejection here on the 25% level, okay, buying theoretically anywhere in this level and having a stop level just below this 25% level, let's put it right here. And I'm going to guess that's probably going to be around an 18 to 20% level. Let's add it to our Fibonacci system. So let's go to 23 and set it to 18.5. Close. Let's try 17.5. Okay, that looks pretty good. And we'll do the same thing up here. So from the 75% level, we'll come down about 17. That would put us at 83.5. So 835. Okay. So here's our 83.5 level, and here's our 17.5 level. And what we're going to do with these levels is these will become our protection. When we get a move safely above this level, this 25% level, like we saw here, a move up, rejection, coming back down, and then moving back up in this manner, up, down, up. This is our breakaway potential phase to the upside. And I've seen people use these over and over again. Okay. It's just simple Fibonacci. Now, your target in this level would be up here at the 618 level or the 7.5 level, which I've drawn right up here. And again, in an opposite trend, you could use this 835 and 764 level. This is a 75% level as a breakdown. So you can see how we got confirmation. We had a very low risk trade here. Your total risk on this trade was zero, was $3.99. Well, $3.70, $3.80. Very low risk trade in this particular move. Now, you've got to remember that you were in an uptrend, you were in a breakdown, you're trying to pull back up. So now, do we get the move here? Do we get that same setup? Well, let's come check it out. Well, we come back over here, we move our peak up to the high point right here. We move our breakdown right to here. We're looking for that same type of setup. Do we get that rejection right down here? Yeah, we do. We get multiple opportunities to buy down here, but we get below our stop level here. So it might be a scenario that we get in, get out, stopped, get in, get out, and finally on the last level, we get all the way up. Now remember, you're trying to really catch that move right down in this area. You don't want to catch it too late, although you can. I mean, this is a nice solid move back up to the 618 level, back up to the 7.5 level, and eventually higher. But ideally, folks, these are fairly low risk trades. Even if you use the trigger mechanism from here or here down to this low, you're talking, 1% particular risk on the trade. You're going to have, 10, 20, 30-day expirations on these trades, but very cleanly playing out. Now, same type of scenario can happen as we move up. So let me try to show you a move up scenario. So you just take the Fibonacci level and you try to come from, let's try it from this way up to this way. So you're looking for that peak to set up. You're looking for it to roll back below. So here we can come from here. You want to wait a little bit, roll back below the 25% level, stall, which happens right here, and then reconfirm. So what you'd have here is a sell setup right over here, looking to move down to this 618 level or 75 level right here. Fibonacci is very, very clean in this manner, and you're using these two levels and these two levels as rejection trigger. Okay, and you're basically trading this middle range, which is right here between these levels. And so you're basically picking the last known Fibonacci level to try to run with it. So there's your trade. And then, of course, look, we come over here. Let's just expand this all the way up and up to here. Now, do we get that rejection? We do, but it breaks down very quickly and crosses into this 382 level. As you're moving downward, you're going to have to protect your equity. So you're going to have to potentially move your stop into that break even level here, or maybe even here as it continues to break down, just like we saw here. Big breakdown, you would have moved your stop somewhere over here, protecting your equity so you don't get into losses. But this is a scenario where it failed, came back up. We could have hit some profit, could have pulled some profit. But again, this is a rejection. It doesn't work every single time. Now, understand that as a general rule, anywhere 20, 30, 40% profit on options is a book it trade. If you get 20, 30, 40% on an options trade and you're just sitting there trying to let it run, you're being foolish. book it. You can always get back into the trade if you want, pick a strike price, pick an expiration date. If you can get, 30-40% on decent trades really easily, it's too easy to really just book it and decide if you want to get back into it. You can always get back into it. Okay. So now, again, simple example. This one rolled downward, qualified, came back here, rolled down into our level, really didn't reject much, but just broke down. So you really didn't have much of an opportunity here, but just broke down to the downside. Let's go ahead and check up here. So we come up to this level. We can operate off of this level if we want, because we can, don't know where it's going to go, but I would operate more off of this level. And you can see that we rolled. Let me slide this down. We rolled into that rejection confirmation area right here. We have a total risk factor of roughly, let's call it from here to here, about 6 points. This is to try to initially get in the trade, and where we're trying to target that 618 and 75 level here just to get out. And we have a upside potential here of 12, maybe a bit more, 14. If you carry it down to the lower level, and we have an initial risk of 6 points. So it's basically a 2-to-1 trade. Okay, but you can see how this type of rejection, and this is what I'm looking for. This is basically my cradle pattern. So remember, I talked about the cradle pattern. Let me come over here and try to show you a good example of the cradle pattern. So this is pretty much a good example here. We come up, the cradle pattern basically is up, down, like this, or down, up, like that. So the cradle pattern is the ability to establish this high and establish this low, which is really lower, down here and up here. And then we're looking for the breakout. So same thing here. We establish this low, this high, and we establish this low, and then we're looking for that breakout. So at this point, you see how we establish this big breakdown level here, this move here, we get this opportunity to try to move into a trade. We would come back over here using the Fibonacci level, try to find the most recent standout or unique low. So I see a bunch of little standout lows here and up here and up here. The biggest standout low that I can see is this one, potentially, and maybe this one or this one. So at this particular point, even if I were to pick a Fibonacci level from here, coming all the way up to the cradle level, we're looking for that 25% confirmation, which occurs right here, back up into rejection where we want to try to take our trade. So where we're looking at is we're trying to take our trade right up. Let me get rid of that again. So that's our cradle pattern. Spread this out. What we're looking at is that setup into the Fibonacci level, the 25 to 17.5 level. We want to see that move into that 25 level and then some sort of rejection, ideally. And then this gives us our entry right over in this area. That gives us our rejection. Now our stop levels, okay, should be potentially up in this area or up in this area, the highest highs. And we should be looking for that 618 area to 75 area back down in this area. We get ourselves a nice clean move down 21 points with a rejection level of roughly, or a stop level of roughly 5. That's a 4-to-1 risk reward rate. So now I'm teaching you how Fibonacci works. And the whole idea behind this is that the Fibonacci 382 to 618 level is the battle zone. So as I've mentioned to you, This is the battle zone. And then this is the broader zone. Now, once we work through that broader zone, and let me move this back a little bit. We have this area here, which is the intermediate zone, the battle zone. Now you can see that when we get into a rejection point, when we come up, we reach a high, we get the cradle pattern. What we're looking for is just to map out the last move, okay? And what we're trying to do is we're trying to find that rotating rejection point once we clear that 25% level or that 75% level. I'll show it to you back down here in a minute. But once we get that 25% level or 17 level, either one, and we get into that rejection, we're in a very low risk trade. So at this point, my risk is only up to right here at 524. I get a broad downward reversion potential move set up, and I'm looking really for this 618 level as my primary target. It's a very simple setup. It really is. So now we come back over here and we'll get rid of this temporarily, and we'll draw our pullback move from here down to here. Funny thing is about Fibonacci is it's everywhere. Price being the ultimate indicator, right? So this was our last trade. Now we've got this breakdown mode. We know that we've extended our breakdown mode. We've reached our level. We waited for this low. We want to see price get above this 25 level right here. I'll draw it in dark green. Once we get above that level, up in this area, we're trying to buy back down in this area. We're trying to buy somewhere below that 25 level down in this area. And we get 1, 2, 3 attempts to try to get into that area. This is daily, guys. Okay. Well, now, target, we're going to try to get out here, or we're going to try to get out here. Now, if we're lucky, we catch a runner, you can let a runner ride as long as you want. But you need to remember, by the time we get up into this area, you're looking at your 20, 30, 40 plus percent move on your options, and you would be foolish to not book that trade. Very low risk trade. Now, fun part about this is daily, is it happens even all the way down here on 10-minute. So come back over here. You take a look at these trades. Okay, we got some gaps here. So you can see we have this move here. Real simple. Come off of this low, come up to this high. We're looking for that rolling down of the 26, 25% level right here. Then we get our objective entry price here. So here's our roll below the 25% level. First roll. Now we're looking for that move back up. You actually get it here, but you get a whole bunch of them right here. Now we're looking for that move down into that 618 level. It didn't happen. We got down to the 382 level. You would move your stop from this level up here down into this 17.5 or 25% level to protect your trade. This would have been a failure trade, but it's a nice setup. So now you've got the breakdown here from this high down into this low. Remember, these overlap. It's Fibonacci. Okay, bigger broad trend coming down here. You get the rotation up into the 25% level right over here, which is perfect. That's our setup. Now we need to buy back down in this low. Perfect. Our stop levels right here. Perfect. And we're targeting that 618 and 75 level. And of course, if we catch a runner, great. Let it rip. Our stop level would start here. As soon as we get up into the 382 level, our stop level would get moved to here. As soon as we get up into the 618 level, our stop level would move roughly to here. And then beyond that, as we're pulling profits, you just keep tagging the stop all the way up into these levels as we keep going. Okay. And at this point, once you're moved here, you're guaranteed a profitable trade up in this area. If your stop's in this area, it's guaranteed a profitable trade. But when you get into a trade, folks, you have to understand the risk. Okay. And again, I'm teaching you these techniques. They work on any interval. I can come down in here to 30 seconds and they'll still work. You know, not every trade is going to be perfect. So here's our last trade coming up. Okay. So we're going to be looking for a breakdown from here to here. We've got to get into the 3.8 or the 25% level here. That's our setup. Move back into rejection here. This is where we go short right here. Then we're coming down. We're looking for this 618 and 75 level. We don't get it. We get the 382 level. Our stop level would initially be up here or down here. Once we get the 382 level, our stop level should move to this 25% level. And there you go. It didn't make any money, but it moved our stop down. This is basically your 25% little options trade. It did great. Okay. Now we roll. So now we have that opposite side. We just came from this high down to this low. Again, this is 30 seconds. This is a 30-second chart, guys. So it's rip. Here's our move off the low. Potentially right here, up above the 2.5 level, the 25% level. Here's our rejection entry. We get a little bit more of a rejection here. Stop level is going to be down in this area. We're looking for the 618 and 75 level right over here. Very cleanly, we roll right back out of it and hit our target. So now we roll all the way up, hit our established top here. Guess what we do? We draw another topping pattern from here. You just follow the last move on up. And here's our move. So you see, we come back down, we get below the 25% level. Then we never really get that rejection back above this 17.5. So what happens here, guys, is we get the breakdown. We never really get the rejection entry level here, and it rolls down. It rolls down comfortably, okay, to that 618 level. But this is where it's more of an aggressive move. So now we do the same thing. We come from here, draw this line down to here. Same type of setup. We get the move higher here. So here's the move above the 25 level. We never get the lower confirmation down here. We do get the roll, but then we rally cleanly up into our target zone and a little beyond. So each one of these little swings that I'm showing you, these middle swings, here's one that I highlighted. I'll draw them like this. So here's one from basically here to here. And then here's one basically from here to here. And here's a bearish one from roughly here to here. These are like the sweet spots, guys. The middle zone that sets up and allows you to get into a quick little trade. Okay. It's not always going to be successful, but this is price structure at work. Remember, you don't need indicators. There are valued indicators. I mean, I built some proprietary indicators that are available to my subscribers, and I'm only allowed to show them off like 3 or 4 or 5 times a year because of TradingView. And I think TradingView, hopefully you guys will be okay with this. I haven't talked about these indicators in 5-6 months, but I think this is the one that I was looking at earlier. This is the SPY. This is my daily pressure system using and highlighting the Fibonacci 382 levels moving forward. So this is the range between the 382 and the 618 level. It tracks them on two intervals, a short term and a longer term interval. This is the pressure exhaustion system indicating trend triggers. You can see the long triggers here, short triggers up here, these little arrows. This is the pressure Donchian system indicating trending and cycle rotations. What we're looking for here is rolling cycle trends, guys. So we're looking kind of rolling cycle trends. And this is the pressure system. It's designed to measure upward cycle rotations, as you can see here. and downward cycle rotations. So the idea here is you can determine what's going on in the market. You see, we've been bullish from right over here all the way over till we get a little rotation here. This is 30-minute. And then we go bearish right here. This is downward trending. We've been in bearish trending in the SPY with the system since May 21st. So it's pretty much moving to the downside. General rule is when price is above the middle 382618 level here, when price is up here like this, you're in an uptrend. Guaranteed uptrend. All the way up. Now, when price gets below both levels, like right over here, that's our below level. Now you're in a downtrend. Okay, so now price is moving downward. And what you're looking for, the pressure indicator, this pressure indicator right up here is kind of cool because it identifies what's called organic and flash trending. So flash trending is here. That's flash trending. That's flash trending. That's flash trending. This is organic downward trending. This is flash trending to the upside. This is flash trending to the downside. Now, what is flash trending? Flash trending is the ability to, let me mark this green, mark this green, and mark this green. Flash trending means typically a failed move. Okay, it can be an aggressive move, but it's going to fail at some point, and you're going to get a reversion. So you can see here, we start to move into flash trending here. We get flash trending back over here as well. I don't know where I put that. I'll draw it again. Get more flash trending here. But what we're looking for off these flash moves is a little reversion. So when we get into flash trending, we want to see a reversion, and then a reversion, and then a reversion here, and then a reversion. That's organic. So here we don't have much, a little bit of flash trending right here. So we'll see how it plays out, but it's this minor little, you're looking for these bigger, deeper V setups. And so we're looking for the same type of thing here. Flash trending, you're going to get up in this area, peaking, you're going to get the reversion coming back down this way. And that's going to be this move here. Flash trending to the upside, you're going to get the rollover down into this low. Flash trending to the upside, you're going to get the rollover down into a low. So given where we're at, we're in bearish trending. We're in a bit of flash trending peak here. We've got a high, cycle high rolling downward with the green, what's called the median green level, moving into a slightly downward cycle trend. So what I'm kind of looking for here with this system is I'm in downward trending. I'm in volatility. I've got a flash high setting up here. And so what I'm kind of looking for is a bit of a rollover move to the downside, a rolling downward trend into Monday, Tuesday, and a rolling downward trend into Monday, Tuesday, Wednesday over here. Pretty clear, especially seeing as though we're below this 382618 level. That to me means that as long as we stay below this level, wherever it goes, the markets are going to just trend downward. Now, the cool part about this is this kind of gives you the range that you can see, Fibonacci range. So you can also see these rotational ranges as they're happening. This is based on Fibonacci price theory. When you start getting these upper little green diamonds, that means you're in a pretty solid uptrend like this. When they end, that means that you're moving away from that uptrend. You get a new low back over here. Fails, we go back over here to new high. We're back into uptrending again, all the way up till we fail to get more, and then we'll roll into this downtrend. At this point, once we start to get these red diamonds, we're in a downtrend. So the idea here is to try to help you guys see what's going on pressure-wise. Now, again, it works on any time frame. Doesn't matter. It's all price-based. This is all price being displayed as pressure waves in these indicators. It is an indicator, yes. It uses Donchians, yes. It uses Bollinger Bands in some cases, yes. But what it's measuring is pressure as occurred in trending. So we come over here to 30-second, you're going to see the same types of pressure cycles. Bearish cycle into bullish cycle into bearish cycle. And again, you can see these cycles play out. They're very clean. Bullish, bearish, bullish, bearish, bullish, bearish, bullish, moving into bearish. Okay, so we come down here. Bearish, oops. Bearish, bullish, bearish, bullish, bearish, bullish, bearish, bullish, moving into bearish. You see that? Now, this is organic trending here, organic trending here, organic trending here, organic trending here. This is flash. This is flash. This is flash. It's very easy to tell because organic trending, you're going to have the organic indicator, the purple level, leading the red level. And you'll have the blue level in longs leading the green. That's organic trending. When the green level leads the blue, like right here, this is flash trending, means it's going to end and roll downward. It means it's going to end and roll downward. So here, it means it's going to end and roll downward. So here we have organic, organic, organic all the way up. This is an organic upward trend rolling into a potential organic downward trend. Organic means natural, having natural pressure behind it. Flash trending, like right over here, this tells us that it's not organic. It's like a counter trend move. So it's going to lead to a rollover. Same thing wherever I find more flash trending. So the organic, organic, organic. On a 30-second chart, flashes are here. This is an organic or a flash low. This is a flash low. This is a flash low. Flash lows mean you're going to see rejection back to the upside, rejection back to the upside, rejection back to the upside. And so again, it's a matter of just, waiting for the market. The market's in upper trending. We can see with the Donchian level, and we can see the cycle systems playing out right here. You can see up, down, up, down, up, down, up, down, up, down. Cycles are playing out very cleanly. So you just got to look for those cycles and then determine, like, we're in the middle of an upward cycle trend. We're bullish. We got this flash trending. This is where you have that opportunity to buy. More flash trending, you have more opportunity to buy. More flash trending, you have more opportunity to buy. Now in organic trending, when it rolls, okay, this is organic all the way up, rolls into flash downward trending again, giving you more buy opportunity, more flash trending again, into more buying opportunity. Then it eventually rolls down into this flash mode here, which gives you a little buy opportunity here, but then it kind of shifts into an intermediate downward trend. So you get this potential downward move right here that stays in a downtrend till right about here on the flash, on the momentum system, and the Donchian cycle trend, because it takes a little while later, rolls over here. So again, what I'm trying to show you is that there are ways that you can use Fibonacci. I'm going to go back over here to 30-minute and come back over here as I've been teaching you to trade these ranges. It's just a matter of, if I clear everything off of this chart, and this is 30-second, come down here to 5-minute or 3-minute, you take the last range. So you go from this low to this high. Pretty simple as you're moving up, and you want to try to wait for that confirmation. So now you're looking for that roll below the 25 level and then trying to get anywhere back above it over here. Soon as you get that roll into the 25 level and a roll back above it, technically you want to see it clearly reject, and you want to try to sell into this range right up here, and you want to try to target this level or this level. And obviously this 382 level, that's your early take profit. Okay. So now we come back down here. We go from this high down to this low. We're looking for rejection down in this area. Do we get it? Nope. It just rips right up through it. Okay, so this is where you probably want to take half a position, depending on where you get in. Because you may be getting in up in this area, your stop level is going to be down in this area, letting it rip, and you're still going to target here and 618 and 75. Target right there, and then if you want to, let a little runner run, and then we'll follow this all the way up into this area, setting up another Fibonacci. Looking for the rollover. We get the confirmation of the rollover here. We get the trigger here. We get the pullback up into this area. Our stop level would be right here. This would end up being a loser. We don't get any follow through. We pretty much go from here to here. Probably doing the math real quick. This is a 3-minute chart. That's maybe 40-cent loser. And that's a loser. It's not going to do anything. And then we have that same setup moving up into this high, which you see here at this point, we don't get down below that 25 level. But over here at this point, we do break down into that 25 level right here. And of course, we get a little rejection right here. That gives us our entry. Our target level again is 618 and 75 down in this area. And then we can let the runner run if we want, and you can see what ended up happening. Big old gap, nice little trailing system. So again, these are not perfect, but this is a measure of risk. I wanted to talk about risk initially, and it's a matter of understanding risk. If you get into a long-term trade and you take a 30 or a 40% drawdown on a trade, you need to really consider getting out of it, moving back into cash, waiting for another setup. That's why I'm trying to show you guys how these setups play out. Same thing happens over here on the weekly. Remove all my drawings, come back over here. Let's get to where we're at. Here's our weekly. So here's our big draw from this low up to this high. Here's our breakdown below our 25 level. Perfect. It rolled down to the 618 level. This actually hit the target. Okay, great. Now we're coming back up. We've kind of already reset again, right? Okay, but now we have this move from this level up to this level. Have we gotten below the 25% level yet? No, but we're technically back in this zone range right here where we have that previous trigger setting up. In fact, I'll draw that as a box. So we're technically between this zone setup from the earlier breakdown trade. So we could take that trade. We would have a stop level right up over here. What we're looking for, folks, is we're looking for a breakdown here and some rejection, and then a move back down into this area, potentially targeting back down into this area or this area. Can you see how these stack? This is the setup area on the bigger range, and this is the setup area on the smaller range. You see how they line up? Look at this. Right there in the middle. You've got overlapping triggers for a sell trigger. All we need is a little bit of a rollover back down into that 566, 565 area, and then some rolling, and we can set up a nice breakdown move down here into these lows. But as we're moving through this uptrend, remember, you have that opposite trend coming from here, from this high down to this low. We have the move higher with no rejection, very minute rejection right down here, giving you maybe an entry right in this area, assuming that you were knowing to use these Fibonacci systems, and we hit our target here, and now we've stalled out. So This is a roll of a trend. This is an early trade. Am I telling you that the top is coming? No, but you should be. I mean, I believe it is. I believe we're going to roll downward. But at this point, I want you to see that you've got this dual setup right over in this area to the downside while we are still potentially in this uptrend. So here's my flagging pattern. So here's my cradle pattern. Boom, 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 boom. Setting up this high, setting up this low, theoretically. Here's my excess phase peak pattern coming up, flagging in this banner. And until we get that breakdown, we're still technically in an uptrend. But we're also in this sell zone. And we're also in this sell zone, which is right over, let me find it right here, sell zone. So how are these sell zones working? You see how you've got this one coming from this low up to this high? That sets up this sell zone once we get that rotation back over here in the trend. Now you've got this move up once we get back below this 25 level, which is right here. Once we get below that level, which we have yet to do, you've got a secondary sell zone setting up right here. So this one is just waiting. All we need to do is get below that 565 level. Then this sell zone becomes active. So what would you do? You would essentially run longer term call options because we're still in an uptrend, potentially trying to trade the primary trend up. And you would set up short term, maybe 20, 25-day put options, potentially setting up into this sell zone. This would be a hedged position where you're essentially betting in both an up and down direction in a hedge. And the purpose of that is that you can try to prepare for both sides of the trade. Okay. Now, if you don't want to do that, that's fine. If you don't want to hedge, you don't get it, that's fine. Just understand that without the hedge, you're taking on more risk. That's how it works. And you hedge in a position like this, you hold two calls and one put, and you set the time level up, the longer term calls, shorter term puts. You're going to be in a hedge position where if it goes up, you'll make money. If it goes down, your longs will be protected somewhat. Okay. And that's how it works. Okay, 42-minute video, much longer than I expected, but the purpose of this was to show you how risk is got to be contained. And so the way you need to understand that is any type of a 20, 30, 40% levels are, let's call them, are targets and risk stop levels. If you can get into the manner of thinking that hitting 20, 30, 40% on a target, you need to be able to book it. That's really good money. If you can protect your long trades or any trade with a 20, 30, 40% stop level, remember, if you get beyond 40% on a risk factor, you're taking a 40% loss on a trade, you probably really should close it and just protect your capital. You can always get back into another trade and wait for a better setup. Okay. So the idea here is, as you get more skilled, you can become more aggressive if you want. But really, I want you to learn this because I'm going to make it as big and bright as I can. This is some rule that I need you to be aware of because, yeah, I might as well make it huge. These levels should be forefront to everything that you do. You should never risk 80, 100% of a trade just trying to swing for the fences. I mean, I do occasionally, but I try not to. So neither should you. Trading is about, think of it this way, it's like a baseball game. You're going to win by getting base runs, not home runs. Home runs are nice, but the way you win is you keep getting base hits, and base hits will win the game. And that's the same thing with trading. Base hits, small profits over and over and over and over again with good risk protection will win at the end of the game. Okay, guys, that's it. Talk to you later.